He can take 5 properties, 6 properties, pay them all off, and he's going to be netting 20 to 30K in cash flow. That's where the real power is. All right, so everyone obviously knows rates are super high right now. It's getting tricky to find cash flow almost anywhere, even if you go far out. And in solid cities like Hamilton, where you can make a couple $100 easily, it's gotten a lot harder. So there's different ways to look at this now, right? Because obviously we needed some stabilization in the market with pricing because it just wasn't making sense. And in order for you to scale up your portfolio as an investor, you need that stability. So I'm going to tell you another way of looking at this, right? And this doesn't apply to everyone. So if you're the type of person that is earning a higher income, you're usually going to be that person that's, investing in some of these properties, because the average purchase price, let's be honest, like in a decent market where you probably want to be with good tenant profiles, is about 600 to 800K minimum, right? Like Hamilton. So you could go far out to Toronto where it's even higher, but we'll just stick to this. So here, yeah, you might not be cash flowing, but you have to look at it from a long-term perspective, right? You have to look at it from the perspective that if you're investing and you're planning to keep your property for 10 to 15 years, what does that look like, right? And what does cash flow look like then? If you're looking to retire right away, I can tell you, whether it was now or even 5 years ago, you would not be able to accumulate enough cash flow from a couple of properties to retire if you had a high paying job. High paying meaning like 6 figures, multiple 6 figures. So I had a client like this, right? He makes multiple 6 figures, and his goal is eventually, not right now, I want to be able to at least replace most of my income. So how do I do that? Obviously, he's not going to pick up a couple duplexes and get a couple $100 here or there, because at the end of the day, we all know with cash flow, it gets depleted as soon as there is some expenses that come up. But this is when cash flow really kind of takes over, right? So let's say you hold your properties for 10 to 15 years, right? You're accumulating all this equity and you're paying down the mortgage. Especially if you want to accelerate it, you're buying value add properties where you're doing renos and you're forcing the appreciation. So you're not just expecting the market to increase the prices of properties, but you're doing value add renovations, like adding a second unit, and you're forcing the value of the property to go higher. If you do that with multiple properties over years, what happens is you'll realize that a lot of these properties are going to have very low mortgages, and you'll probably be able to pay a couple of them off. All right, let's take a look at that big picture wise. If you're getting from a duplex in Hamilton right now, 43 to 4,500, yeah, maybe if you bought it a couple years ago, you're going to be cash flowing a little bit, but 10, 15 years in, your mortgage gets paid down, right? You're going to be cash flowing a lot more. But the real, I would say, advantage is if you can take some equity from some of your other properties, or even sell off if you need to, right? And you pay off a couple of duplexes, and each one is bringing you net cash flow of like 4 to 4,500. That's when the real power of real estate kicks in, right? So for my client, he's looking at it like, okay, if I make a couple $100,000 a year, how do I replace that? I'm not going to be able to do that right away. But 10 to 15 years from now, he's picking up a property, let's say like 1 or 2 a year, right? He can take 5 properties, 6 properties, pay them all off, and he's going to be netting 20 to 30K in cash flow. That's where the real power is. So you can't think of it as like now money. If you think of it as now money, even a couple of years ago, if you thought of it like that, you'd be like severely disappointed, because that's not how it works, right? But over time, as you accumulate equity and you pay down the mortgage, and you have these properties in solid areas, remember. So these are good assets in good areas where you can get solid tenant profiles. They're reliable for you to be able to hold on to them. Those are the properties you should be going for. Those ones, you can definitely use that strategy. And in 10 to 15 years, let's say you start like me, I started in my mid-20s. By the time I'm like 40, I don't need to work. Right? I'm not saying this to brag, but I showed this to my client because everyone tries to complicate this stuff, right? Like everyone gets sold dreams. I was too. There's hard lessons I've learned. Everyone learns this stuff. It's like, you got to buy apartment buildings. You got to buy this. You got to 10x. Like the thing is like that stuff is all cool, but you're getting into very complex strategies which don't actually come into fruition until a couple of years. Just like what I described, but what I described is much simpler, right? You don't have to deal with multiple tenants, large buildings, etc. But it doesn't apply to everyone. See, that's the thing. So this applies to certain people, obviously, and those people are usually the ones that are buying properties that are, in these areas. Like they're the ones that can afford it. So if you're a newer investor, like even me, like when I started, properties were a lot cheaper. So I totally understand. You don't have to do this. It might not make sense to you. You might want to go to a smaller market where you can get cash flow right away. And again, remember one thing, you don't want to buy a property that's cash flow negative. We're talking about properties where you're at least breaking even. And even if you're making a couple $100, I don't think that's really income, because like I said, what if you got to replace a fridge? That $200 a month is gone that year, right? But once you wait that 10, 15 years and you're accumulating that equity, you have, let's say 10 properties, you take 5 properties, you sell them, you pay the other 5 off, that's it. You're good. And it doesn't have to stop there, right? I'm just using a simple example. You can take this a step further. You can partner with people, buy more properties. It's up to you at that point. Like it really becomes kind of like a personal thing. Maybe you want to start buying buildings, whatever it is. This is a simple strategy you can use now and forever, right? That's what it is. But just buy solid properties in solid areas. Otherwise, you'll be disappointed, because you can buy high cash flowing properties on the other side in areas where maybe they don't have the greatest industries. It's not reliable markets. They're boom and bust markets, right? So you don't want to end up in that situation, because now you're holding something like that for a long time and you can't even sell that tomorrow. So just be careful, and that's the advice I would take. And that's what I wish someone had explained to me a long time ago, so I would understand that even simpler, right?